A majority of the stock market has already bottomed. Believe it or not, inflation is actually coming down, with the core PCE data coming in lower than analyst estimates, and the recessionary fears of 2023 are starting to ease based on the GDP data we just got for last quarter. And it also seems like this earnings season is not as bad as many people are expecting, as most big tech companies have come right in line with analyst revenue and EPS estimates. I'd say with all this data, there's a very high likelihood that 2023 is going to be a decent year for stocks because the macroeconomics have been the main driver for market volatility, and those macroeconomic situations are starting to improve. So what exactly could 2023 look like in both the worst case and the best case scenario for the stock market, and how could that translate into your own growth stock portfolio? In this video, I'm going to conduct some technical analysis, look at the relationship between the Fed funds rate, inflation, and how stocks tend to historically perform in a time of high interest rates, which I'm sure you guys will find extremely interesting. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So first things first, we need to understand the relationship between interest rates and inflation. Many economists have said that the only way inflation is going to really come to 2% is if the Fed funds rate is higher than the year-over-year rate of change of the core PCE. And as you can see, believe it or not, that is about to happen next week. Next week, we're expecting the Fed to raise by 25 basis points, which would bring their effective funds rate all the way up to 4.6%, which would be 20 basis points higher than the current PCE report, which, by the way, fell from last month. And as we all know, higher interest rates are not a bad thing for stocks or the economy. They're typically a sign that the market's doing so well that the Fed has to slow it down to make sure inflation doesn't affect the middle and lower class too much. But right now, the problem has always been that the Fed funds rate was getting aggressively high in a very short amount of time, which meant many companies did not price that into their projections, which led to a decline in earnings and revenue, and obviously the stock market being down 20%. But I'm sure many people don't realize this, but the stock market is a forward-looking indicator, meaning the 20 to 30% decline that we've seen in the Nasdaq, for example, over the past year is pricing in this recession that right now the data is showing us. If retail sales fall, if PMI indices fall, that is actually a good sign and validates the reason why equities have been destroyed in the first place. The reason why your equity portfolio is down for the past 1 year is not because of this recession. It's not because of PMI data. It's not because of retail sales. It's because of two things: the Fed funds rate and the inflation rate. And so if those two things are now starting to ease and the economic outlook is starting to look good, there's a really high likelihood that the market's not going to start caring about that, and it's going to start caring about other data that might be coming regarding earnings and recession. And although we're not fully done with the current earnings season, so far for the last quarter of 2022, earnings has not been that bad. Yes, they have declined on a year-over-year basis for most companies, but the thing that really matters is how have earnings fared compared to how analysts had projected them. Tesla, Google, and Microsoft all beat or came in line with analyst estimates, which just validates the thesis that this recession is being priced in by more people and more investors than you actually think. And when you have stocks like Google climb 5% after news of mass layoffs, which are supposed to be a bad thing, you know we're near that eventual capitulation bottom. Because if investors now think that bad news is actually good news, it means a lot of the bad news has already been priced in by markets. And that's been a very similar case with even riskier assets like Wayfair that might be unprofitable. JP Morgan double upgraded the price target on the stock after they announced job cuts, and the stock is up over 27% in less than 2 weeks. If this is not a sign of retail and investor capitulation, I don't know what is. And all this is being run by the fact that most investors have priced in a 47% chance of a recession in the next 12 months. Now, believe it or not, I think a recession is probably going to happen, but it's not going to be as deep as many people think. We're not going through a tech and telecom bust. We're not going through a great financial crisis, because those situations were developed by actual fundamental problems with the economic system. The only fundamental problem that we're dealing with today was more stimulus checks that were handed out in 2020 and 2021, which led to inflation being high, which led to overhiring, which led to a lot of spending, which obviously had to all cool off. And although as a long-term investor, I don't really care what inflation does in the short term because my companies are designed most of the time to survive through these short-term hurdles, I still want to make sure I cover all this information because there's a lot of investors that trade on a much shorter term basis, whether that be for tax loss harvesting or understanding if some companies are better buying opportunities in this environment than others. And for those reasons, I think it's really important to look at this inflationary data, particularly the leading data showing us what's going to happen within the next few months. People got so caught up in this recessionary fear that we saw on social media and Twitter and YouTube that people forget to realize the US economy is actually going at such a fast trend that we are just returning back to the pre-COVID trend that we saw in the US real consumption. And trust me, if the government is able to pull off this soft landing where GDP data doesn't come in as bad and inflation does start to tick down to 2%, which is already starting to do, then we're going to see an epic relaxation in market valuations, and the US market is going to start following what the Indian and the Chinese stock markets have done. Emerging markets have significantly outperformed the S&P 500 over the past 6 months. The Hang Seng Index is up almost 40% from its bottom. And this is all after people realized that Chinese investors are super linked with the US investors. So if China was going through a recession throughout 2022, that is deflationary for prices and inflation in the US. And that is exactly what's happening right now, where the US is now lagging what's happening in China because their inflation rate is higher. So what can happen in 2023 if US inflation starts falling? It could be a very similar situation to China. And for all the people saying that higher interest rates are bad for stocks and investors, well, I beg to differ. As you can see, throughout this 1975 to 1980 period, while the Fed funds rate was actually going up, the market still ended up rallying. If you bought the top, yes, you're a bad investor. But if you continue to dollar cost average and buy the companies that you were confident in and you believed in, you actually made a lot of money. Even during a time that many people would be considering this a lost decade where the market did nothing but go sideways, if you actually added during these kinds of dips, you actually made a lot of money on these massive rallies that many people would still consider a bear market rally. But there's no history textbook that says you can't make money in a bear market rally. So even if you're a short-term trader, there's plenty of opportunity this year to make money if you're trying to play the long side. And no, unlike what many people think, the market does not need to bottom only when the Fed starts cutting rates. As you can see right here, the market found a very decent bottom in 1962, even when the Fed was raising their Fed funds rate. And as you can see, even if many people thought this was just a bear market rally right here, and we saw the second test, the market completely disagreed for the next few years. And for those of you asking, why are interest rates so low today compared to where they were back then? Well, as we all know, technology is a deflationary force. We have more consumer electronics in the hands of people than we've ever had over the past 100 years. And that is exactly what deflation entails. Deflation is about improving the productivity of day-to-day tasks and making sure that prices are able to match what consumers want to actually pay. E-commerce has played a big role in this as well, and that's why interest rates have been low, because we're in a time of deflation. As a result, the Fed does not want to throw us into this longer-term recessionary period. Instead, they want to stimulate growth in the economy and more innovation by cutting interest rates and being it low. And funny enough, even in low interest rates, we found good ways to not increase inflation, which just validates the idea that so far the inflation's only been caused by stimulus checks, which again were a short-term thing and have been completely spent. And for those wondering whether or not the S&P 500 is actually bottomed given the insane rally we've seen, I think the chances are well above 60% of that already happening. I think October has probably been the low for this bear market cycle because not only did we make a higher low right here, but we also just broke above this extremely long and well-respected trend line which was tested 4 times. This is the trend line that many people have been using for shorts, and as you can see right now, we're starting to see a short squeeze in the market where all the people that shorted up here now have to cover their positions. And what's really funny is you could have seen this a mile away. Stocks like Meta already bottomed back in October, even though many people were talking about this stock back then, but nobody's now talking about the insane rally that it's had of over 50% since that time. And it's a very similar case with Alibaba. This stock bottomed in October, but now that it's up more than 100%, nobody's going to talk about it. Everybody was talking about how Baba is a bad company back then, but nobody wants to talk about the insane rally that we've had. This is the sign of the next bull market starting, where it's starting at the most riskiest assets first. The companies many people thought were dead are bottoming, and now that's going to lead the overall index to start rallying throughout the earnings season. Now, personally, my own portfolio has been more risky and it has not performed just as well as those stocks, but in my growth assets, I know that there are some companies that are going to perform better this earnings season than others, and I am willing to deal with the short-term volatility for the eventual ride in the next bull market. Obviously, some companies might not make it, but that's my job as an investor, which is to manage the risk with the reward. I want to make sure I lose less money on my bad companies than I make in my good companies. And that's what I plan to do, even if the past year has been quite difficult as an investor. But obviously, guys, that is just my take on the situation. So let me know your thoughts down in the comment section below. As usual, thank you very much for watching, and I'll catch you guys in the next one. Take care.